It's so good to have all of you here. My name is Irene Gathiaka. I am the founder of Nairobi Business Forum, and I am also the Africa Director at Total Impact Capital, where we finance impact investments in small businesses. Today, I'm delighted because I'm waiting to hear about saving, and I'm hoping there'll be a new spin on it, because everyone knows that saving is good for you, but given the times that we are in now, we do have to make it work. And I'm hoping that Njeri and Edward and Simon will break it down for us to make it work, even at times when it seems like you're saving, but even in a savings account, you might be losing money through inflation. We want to dissect all of that. And so without delay, let's get into a little bit about our panelists. And I'll start with the ladies. So Njeri, introduce yourself and tell us about what you do and where we can find you if we want to find you. Thank you.
Thank you, Irene, and good morning, participants. It's good to be here at the Africa Wealth Conference 2022. My name has it been indicated, is Njeri Jomo. I work with Britam Holdings PLC. I'm the General Manager for Retail Business Development, where I'm essentially responsible for everything that relates to the individual customer or the retail customer with regard to insurance and wealth management. Why is this such an interesting conversation for me? Because I'm passionate. I'm truly passionate about wealth creation. It's been 20 years for me speaking to customers about building their wealth, the different ways they can protect their wealth through insurance, working with young people on talent monetization and how to make sure that they begin to build a savings and investment culture very early, and definitely looking forward to the great conversation this morning.
Thank you. Thank you, Njeri. It's very nice to meet you. And now we know why you're here, because you're passionate about empowering young people. To start off right, Edward, I'll ask you the same. Where we can find you, what it is that you do, and why you're here today, why you're passionate about this topic.
All right. Thank you, Irene. Pleasure meeting Njeri and Simon. So I run a fintech. I co-founded a fintech called Uplus, and the idea is that we believe when people pull funds together, they actually can do so much more and moving their lives forward, from saving to investing those funds in a particular project or an asset. So Uplus basically means you plus me equals wealth. And we're passionate about getting people to that next stage. We start you on that journey. We say, start simple, just start saving. And once you start saving, then you can get projects to invest in so you can grow your wealth. And then obviously, as the year ends, we'll be launching a unit trust on our platform. So now your savings can go into unit trust that earns a return greater than having your money in a fixed deposit account.
Thank you. And just to add, you're logging in from?
Sorry, yes, I'm logging in from Kigali, Rwanda, and you can find me on LinkedIn online at Uplus Mutual Partners.
Yeah, that's just to make sure that anyone listening, this is a Pan-African event. It's not just for one country. It's not just Kenyan, and so we are happy to proceed. Simon, have we lost you?
I'm back. Sorry,
Okay.
I had an internet issue,
Okay.
but thank you, Irene, for having me. My name is Simon Wafubwa. I'm the team leader at EnWealth Financial Services. We are a pension provider looking after assets of around 850 million USD in 3 countries, Kenya, Uganda, Mauritius. Our passion is to see that we secure a lifetime of financial well-being and dignity for our customers, and happy to join the conversation. Thank you.
Thank you, Simon. We now know that all of you are experienced in your field and you've managed money, so you know the trends. So let's start from the beginning. How do you, and this I'll direct to you, Njeri, how do you make wealth from saving, putting money away? What's the most that you can do to optimize that space?
Thank you for that question, Irene. And often, as you said, life has become quite challenging. Money is not perhaps the most available resource. So often the question is when, should I even be saving? I'm just struggling to make ends meet. But I believe savings really begins with, it's a habit. It's creating a sustainable habit and making a deliberate decision that you must save. Why? Because no matter what you do, you're going to need money for a rainy day. It's down to frugality is key, living below your means, being able to say, saving is something I must do, putting it as part of your expenses, saying that, for example, if I'm earning, for argument's sake, 50,000 shillings, if it's in Kenya shillings, if I'm earning a certain amount of money, what percentage of that do I want to go into savings? And deliberately working with whatever else is left to make sure that your expenses fit within it. Saving is really more about habit and building a sustainable habit that you can be able to do. We're not even discussing growth here. We are discussing putting money away consistently for a reason. And there are aspects that go into that. First, what are you working with a budget? Or is it that every time you have money, you're sort of spending as you go? Or are you actually sure of where your money is going? And often I like to say, when you speak to most people, even when it comes to budgeting, there's often the budget that they do and how they actually spend their money, which in some cases tend to be two different things. So where is your money actually going? Do you know? And whatever you choose to decide that I'm going to save, because you're clear that you're deliberately creating a habit, that you automate it. You're not waiting to make a decision every other week, every other month on how much you want to put aside. But once you've made a decision that this is how much I want to save, you create or automate a process where this money is actually put aside. So for me, savings is really the foundation of it. Saying I need to build a habit, a sustainable habit, where I actually put money away for a rainy day because it will be needed and because I don't want to live hand to mouth, and making sure that you deliberately budget it as a deliberate expense that you're going to have, a saving expense that you're going to put something away. And you know, the interesting thing is about habit. Whether you're earning 10 million shillings or earning 2,000 shillings, the funny thing is we behave the same way with money. You don't get better at saving when you have more money. You start off deciding that this is what I want to do. So for me, as I've said, saving is foundation. It's about building a sustainable habit that is a key foundation for wealth creation.
Thank you, Njeri. And so to you, Simon, then, you've been in this space a while. Saving as a culture in Africa, because we're addressing Africa now, we have people from all over. What are the challenges that we encounter at high level? And then how do we start to kind of chip away at those challenges so that we make a habit of saving, because we are poor savers, it's well documented. How do we kind of flip that and start to think long term?
Thank you again, Irene. So first is, allow me just to touch a little bit.
Edward, can you hear me?
Yeah, I can hear you. I think it's Simon's video.
Yeah, so I'll ask you the same question and then he'll come and join in from there. So especially from Rwanda, I do want to hear your perspectives on the savings culture and how do we get better at it as Africans?
Sure. It's actually interesting what Njeri said, because I can actually relate to that. When we work with groups that, cooperatives are trying to pull funds together, we find out that people actually who earn a regular paycheck at the end of the month are the terrible savers, right? But the people who are earning irregular earning, they're the best people saving, because they kind of understand their certainty in when the next income will come in. So you have even young girls who are 18 or 13 years old who are putting money aside to, support their next venture. So what I tell our customers is, don't even think long-term at the beginning, because that might be too much for them to understand. And they'll feel so stressed out. So I say, just think about, if you're earning a regular paycheck, think about 6 or 7 months of what you're earning and start putting that together, right, slowly. Then once you hit that target, hopefully it will take you, 12 months or 18 months to get that target, that habit, right? It's about creating a habit, like Njeri said. It's like create a habit. Once you create a habit, then when you're moving up that ladder, the financial ladder, it's not hard for you to understand how to get there. Right, so we start them small. We say it's not complicated, even though it's $100, $50, $20. Just get into the habit of putting the money aside And once you get used to that and you start living within your means, then everything else becomes possible. Because even if your income increases, maybe you get a promotion and get another job, you'll be used to spending a particular amount per month. So the idea is not to earn more, because what happens when you don't have a discipline, when you earn more, your expenses somehow find a way of filling in that gap, right? So what we tell them is like discipline, get the small steps first, create that foundation, and once the foundation is there, then, and it takes time too, because I think people sometimes want to do this really fast, right? They want to get a savings, they want to invest in a property, invest in the market, and say, no, it takes time. And the idea is that you have to change that habit and get inside of it. Once you do, then you're on that journey.
Simon, you're back. Glad to have you back. You heard what Edward said, to saving and getting to that habit. What's your view of how we are behaving in Africa, and are we getting better at it? And how do we get started in just making sure that we are now saving and making sure that we are not waiting for an emergency to start running around?
So thank you again, Irene, and my apologies for the internet challenge I have. I wanted just to say is that the first pillar is that we need to build income abilities. So there are 3 levels of income ability. One is that you need to earn the income to be able to save it. And that has to do with within the abilities for attracting money our way. There are 3 things. Money need to trust us to flow our way. So the first one is competency. You need to be good by way of skill to solve a problem in the ecosystem of resources around you. Number 2, when money comes, it's sort of a relationship with the spouse. If it's abusive, it will go. So that has to do with the character. And then the third one is credibility. What's our track record of relating with money? So I think once we deal with that, the pillar number 2 then is that part of the pullback around disposable income is what we call plaque tax. So the levels of dependence in Africa is extremely high. You find
Oh, it was just getting interesting.
If they don't help.
Simon, I'm going to ask you to log out and log in again, because we are losing you and it's just getting interesting. So we really, all of us want to hear that. And we have quite a few people with us. So ask questions so that while the panelists are talking, then we can start to see what areas to address. So post your questions on the wall and we can take this forward. Simon, if you don't mind, logging out and in again. And Njeri, about saving and creating wealth from saving. And as he was getting into it, the black tax and things that might derail our savings. So I'll ask, while we wait for him to come back, we are now started on saving and we don't want it to just be a savings. We want to start creating, making that money work for us. What's your view on making sure that even as we save, the money that we are saving goes a little further than just savings in terms of investment?
Thank you, and you're right. It was just getting interesting with Simon and touching on black tax. I can't wait for him to get back, because that is a very African concept, you know.
And very real. I'm sure Edward would agree, very real.
Yes, we go to school and grow up and make money to take care of our parents. So I do look forward to really us unpacking that fantastic, very African concept. But to your question on stretching the shilling, is saving, as we've said, is a foundational discipline. It's about developing that habit of putting money away. But then there's a question of saying, how does this money work for me? And in the discussions yesterday and perhaps part of this morning, the whole conversation of active versus passive income, the fact that we work for the money we earn on a day-to-day basis, but we can only earn so much. The money has to be able to make money for us, which introduces a great concept of investing, making sure that this money is making money for you. So for us, and for me, I keep saying, and when we advise our customers, we keep saying customers are as different as they are ways of investing, and wealth creation or whatever is considered a good return is dependent on the client. Often what I like to say is the first stage we must begin for you to stretch your shilling is the goal. Why do I want to invest? Because often if you invest for, or if you try and stretch your shilling for the sheer sake of it, why would I give up spending it right now or later? Why would I want to put it away? You really must be clear on why and what goal is that is driving you to put it away. The first step, obviously, is it an emergency fund? Is it taking care of the immediate in case I lose my income? The second thing is, what are those longer term assets? Perhaps I have a family, I have children. I need to make sure I safeguard their future. I probably have a business. What are those aspects you want this money to do for you? And there are many ways that your money can make an extra shilling for you, which we have discussed extensively. But who you are as an investor is important. What is your risk appetite? Are you risk averse? Are you the kind of person who's happy with longer risks? And there are basic models that we use to define this. And we define different investor stages. For example, when we are younger, we say we're in the accumulation phase. You can take on a bigger risk appetite. We go even simpler and say you can go home this evening and not eat, and there'll be no riot in your house because you can take water and say I'm saving, or you can take a lighter meal and say I'm saving. And then we move on to the next phase, which we call the consolidation phase, when you're beginning to put together your assets. At this stage, we say you have some monthly expenses coming through, but you also have longer term dreams still coming. And at this stage, we look at a client who can take on more of balanced portfolio, some high risk, but some that take care of the today. And as you go into deaccumulation, you're older, you're taking on less risk. So essentially, who you are as an investor is important. Why you're investing is important, even before we begin to say, how are you going to stretch your shilling?
Okay, thank you. And Edward, then I'm thinking, before we go to investing as such, is saving the best way, a good way even, of creating wealth? And the reason I'm asking that is because we all know what has happened to a lot of African currencies. They were one level at the beginning of last year. If you have savings the same amount and you haven't used, it's depreciated somewhat. And so it has, even though it's the same amount, it won't get you as much as it could get you last year, at the beginning of last year. And that's a reality that we have to live with. So my question then becomes, how do you optimize that space of saving so that even if you have money that you have saved, it's looking like you're looking for the best savings products out there so that you get the best out of that space as opposed to just leaving money in your back? What do you tell clients that say it might not be worth it to save because it looks like we are losing value of our currencies, whatever they might be, throughout?
Right, thank you. So that's goes back to what I was saying earlier on with the unit trust product that earns a rate that's higher than most in the market, actually beats inflation. So I tell our clients that you put your money in that unit trust, which is offered by one of the biggest local banks here, Bank of Kigali, right? So once you do that, you can mitigate some of that inflationary risk. Yeah. Okay, instead of you holding it in a current account or holding it in another saving instrument. So as you're waiting for maybe your next project to come through or get enough funds to invest in your next project, you're holding it in a vehicle, in a unit trust, and that earns a rate that's higher than what's in the current account and also with inflation. That's how you can solve that problem. And that was launched in around 2020, so it's relatively new. But I'm glad more of those financial products are going to be hitting the market. So giving savers a lot of options to see how they can protect their savings.
Okay, and Simon, you're back, and it seems like now we can hear you properly. I'll hope that it stays that way. You were just going to tell us about the trends of investing in Africa and the black tax and issues that would, derail your goal, that you have the best intentions, but all these goals or other interferences from our cultures then make that difficult. How do you manage without alienating yourselves from your loved ones or failing to meet what would be considered your obligations?
And unfortunately, when you look at the way most of us manage money, we don't have a personal strategic plan. Not many people actually have what you call the money vision, because money answers to why. We tend to focus more on how than the why.
Yeah.
So I think for me, the starting point should be, why should one have money? That's the money vision. Then you go to the how. The how is, so in what channels are you going to earn that money? And that can be either as an employee or you are a business owner. And whether an employee or a business owner, so trust is key. Steve Covey would say, in the ecosystem of high trust environment, you get resources quickly, cheaply. And I defined trust, competency, character, credibility. Now, once.
Oh, yeah.
Irene, you know.
We kind of lost you there. So you're going to have to repeat that point. Yeah. The last point.
You can hear me?
Now we can, yeah. Repeat the last point.
Okay. I don't know at what point you lost me.
You were going about the third character.
Yes. So I was just talking about that in the ecosystem of trust, then we have to ensure that there's character, credibility, and competency. And I have come across cases where someone is honestly incompetent. You see, you can't attract wealth your way. You have the character, you're okay, but when it comes to delivery, because you don't have the requisite competency, the skill set, whether as a business or as an individual, people won't trust you with opportunities. So it helps to actually balance those three items that I have talked about. Now, once money has come, and I share this jokingly, Irene, money like to stay in a tranquil, peaceful environment, not in a very noisy, annoying environment. But to grow it, allow me just to run you through a script that I developed. And this is just to relate some football lessons around growing wealth. One, each football team has a coach. So you need a money coach. Irene is here, Edward is here, Njeri is here. No matter the talents we have, the coach helps us to bring the best out of us from an external view. Number two, each team has diversification of players. The strikers are equities. The midfielders are fixed income securities. They once in a while pass liquidity through balls. Defense, real estate. They hedge against capital erosion.
Yeah.
So diversification is key. In a VUCA world we are in, sustainability and resilience works better when you have diversified your portfolio. VUCA, extremely volatile, uncertain, complex, ambiguous. For example, in Kenya, the day Russia hits Ukraine, a day after, our stock market lost 92B.
Yeah.
It's the world we are in. Now, number three is substitutes are allowed. And you find someone is emotionally connected to an asset, is underperforming, upload a land, and is actually earning a return of, say, 2%. But say, for example, in Kenya, you get that same land, you put in a government bond, you are getting a return of, say, 13% or 12%. far much higher. So you get people who are asset rich, cash poor. Doesn't work better.
Yeah.
Number four, it helps. Each team has a strategy. There's no team that doesn't have a strategy. So it helps to have a personal strategic plan, even in terms of your wealth creation agenda. And so within what value system is important, because in there,
Simon, we
often
Simon, we're still struggling with connectivity. We missed that. I don't know
if
there is.
You can hear me now?
Now we can, yeah.
Okay, so just to wrap it up, I was saying that often for parents, they work so hard to focusing on what they are living for their children, but it's not so much. That's the value system. Because once you deal with that, they will grow what you leave them with them. Probably the last two around football lessons is that work with the end in the mind. On minute 90th, the game must end. Even if we have some extra time, the game will end. And so whether it's at retirement planning at age 60, 65, people will leave employment. So it's important to work with the end in the mind. And then finally, each team has a cheering squad. There are times in life you need people to stand by you when things are not very good, to cheer you up. Thank you.
Thank you. We've heard that, and you've covered quite a bit, because that's what I was going to ask Njeri. And Njeri, to his point, then it becomes, we have some money, we are saving, then we are going to look at investments. And as a beginner, if you have some money, people don't quite know where to go. And we kind of, we know what's happening now. There's all these fads, some are real, some are not. Go and put your money in crypto. And then there's the African one that we love so much, go and buy a plot somewhere. Yeah, and then there are all these other competing interests. There is money that we are borrowing from mobile lenders. How do we stay focused on the narrow and say, this is my investment plan and I'm sticking to it? And then how do we choose that investment plan?
Thank you. And you know, as you're saying, there are many competing needs for the money that we have. And as I started earlier, and I think even it's been touched on, is the aspect of saying, why am I saving? Why do I want to save? And who am I and what's my risk appetite? Now, the one thing about anyone speaking to you about investments is we are all very knowledgeable, but we are knowledgeable for many. And one of the things that I like to do with my customers is sit down with them and say, okay, why are you investing? What do you want to invest in? Typically, how long do you need it? Because if you think about even organizations, they have short-term goals, they have medium-term goals, they have longer-term goals. How long do you want to do it? If you tell me it is something where you're going to need money, perhaps in the next 3 months, then I'll tell you that is automatically a short-term, and therefore low-risk investment as a relationship. And therefore, you'd be looking for something like unit trusts. And I'm glad to hear Edward speak about that happening in Kigali. And I can tell you, in Kenya, unit trusts are very many. You want to think about, is it a fixed deposit? What is that offers the opportunity? And there are a couple of things you're looking at in an investment. The first thing is, what are the underlying investments that are supporting that? If you're talking about, for example, investments that invest in treasury bills, treasury bonds, corporate bonds, commercial paper, then you're saying that is a low risk investment. If outrightly you're being told this investment invests in shares, then automatically you're looking at probably a more volatile, higher risk investment, and therefore needs a bit more of a longer time for you to do it. But what I'll tell you is, as you go through all of this, and this has been spoken to by earlier before, is the aspect of saying, take time to educate yourself on the various investment vehicles, because there's some level of information you may have, but I cannot advise more about going to a money doctor. go to a professional who sits down with you and helps you select. One of the things that you'll find about the investment world, it's broad and it's deep.
Yes.
And there's the aspect of not just the right vehicle, but also a partner that you can trust. And that has been touched on a bit in terms of saying there are many types of investments, but you could also want to know who is behind this. Is there some, can you see experience behind it? Can you see a track record of performance? Or is it a briefcase, the type of company that's showing up tomorrow? No matter how good the deal sounds, you will want to check that fine print. So take some time, get to know yourself a little better, because you need to know, what do I want? You don't want everyone telling you what you want. They could guide you here and there, but you really are probably the best expert of you. And then 2, take some time to educate yourself a bit about investments. And then thirdly, go to an investment professional. You want to sit down, and throughout the Wealth Conference, you're hearing from very many. Take time to listen to what they tell you, but don't make a decision immediately. I like to advise. You now have the advice. Step back, go through it, and make an informed decision.
Thank you. Thank you for saying that, because now that we are getting to the place where, okay, there are all these investments, Edward, I'll come to you then and ask, what for a beginner, perhaps somebody who's got a little bit of a lump sum, but it's still, you're still young, you're 35 or 30 to 35, maybe to 37, and you're constructing a portfolio. What does a good savings and investment portfolio look like? And it's not so much the amount of money, it's more like the split. How do you make sure that you're sitting within your portfolio is such that when emergencies hit, you don't kind of break away from savings altogether because you didn't do it right? What does a good portfolio look like?
Right, so from the beginning, what I like to say is, I say, okay, at least 60% of that, from the early stage, is you're building your safety net, right? And you focus on building that in case something happens. Talk about the black tax as well, family emergency, health crisis. You have something, so I can tap into this, so I can finance this emergency. So from the beginning, you want to make sure that you're building the safety net. You're young, you don't have a lot of dependence, you don't have a lot of debt, you don't have a lot of things going on. So once you build that and you reach your target, then you slowly start going up that ladder. So that's what I tell young people who are in the finishing university, because even that's our target market. And say this, when you start working your first job, start building that, okay? Because you're not buying your first property, you're not thinking about getting married yet, some of them, right? So focus on that. Once you get there, then you have a comfortable 6 or 7 months of cash in there that will be able to come in and help you in case of an emergency. And then you now. What I say is that you now have a clear head to start planning and thinking about things you can get involved with. And I want to touch on something Njeri said about time, right? Because most people, when you talk about, get advice, get someone professional to help you with, they'll say, oh, I'll get to it, or I don't need it. What happens though is that the first year goes by, second year goes by, third year, then you're getting to another different life scenario. And 5 years has gone by, okay? And that is just eating so much into your investment. So I tell people, even though you have little, just start getting into it so that you can start understanding and learning, because this, this curve you're traveling up, this knowledge journey as well, you need to go up. You cannot just get it in the first or second months, right? So what I do with some of my clients, on a monthly basis, just to understand, ask questions, to digest the information, see what's happening, so that maybe in 12 months, they get a better understanding and actually appreciate what they're doing. So it's a time factor too. They need to put the time in. It's not going to happen overnight, and it won't happen when they want it to, right? They have to appreciate what the amount of time it takes.
Thank you. Thank you. And Simon, you're back. So back to you now, because all I'm hearing is investment is start now, which means that we are also considering the effect of compounding. If you're starting now and you're looking at a balanced portfolio, you will tell us what that looks like if you consider a portfolio balanced. Then what's your advice on people who are thinking, I could start later at 45 instead of starting now at 30? And what are the missed opportunities there?
So thank you again, Irene.
Njeri, that question will go to you, because clearly we are having trouble with, yeah.
All right. Why start now? I mean, there's a very common phrase: the best time to plant a tree is 20 years ago. The second best time to start it now. Why do you want to start now? The power of compounding. There's an interesting effect to investment. We said it starts with habit. It starts with starting with whatever you have and beginning to develop that habit. But you also realize that when you and I think there's an illustration I saw. Is it a couple of weeks back on showing if today someone offered you 1,000,000 shillings and if someone offered you 1 cent compounding on a daily basis, which one of the two would you want? I'd ask us to go and do that math. But it will be shocking for you to realize how 1 cent on a daily basis over 30 days could easily get you over the 20 million mark. You know, and yet I'm asking you, do you want 2 million or do you want 1 cent every day? Whatever you have may look little, but what I keep saying, it's about respecting the little you have. And I think Simon has spoken about money doesn't like a place that's too noisy or not being respected. I also think money likes a little respect. The 1,000, the 10,000 you have, the 5,000, the 2,000 that you have, that you put it away consistently. Return has an interesting way where the money you have earns more for you and continues to build on it. So it's your money making money work for you. And then whatever you've made making you more money, which incidentally has an interesting effect. And that is what I think Irene is referring to as compounding. It's a compounding effect of money. So it's a choice between spending money now. And I like to use the example, you eat what you have right now. What you've eaten is a seed. You have an option, eat the seed or plant the seed and get a forest instead. Then you probably can have as much tree as you want. So at the end of the day, is what you have right now, regardless of how little, is the seed. Put it away, invest it. There's some cost to it, yes, because you could spend it now, but you begin to see that as it compounds, it grows. And the interesting thing I've seen with most of our clients is you begin to realize that you can actually live off the interest. And this you see, especially for those who have accumulated some sort of lump sum, that as you accumulate a reasonable amount, you can actually live off the interest. So whatever you have remains intact and the interest becomes sustainable. So regardless of how much you have, it's best to begin now. But even if you haven't started, and you probably wanted to start when you were 20, and I spoke to this about the accumulation, consolidation, and the accumulation phase, please start now, because it's always the opportunity to begin building a habit and begin accumulating a reasonable amount. The goal is to put it together. The goal is to get it to 50,000, 500,000, 1 million, and that is achievable with what you already have at hand.
I will thank you, Njeri, for that. I'll come to you on all the savings and investing and how they relate to insurance. But to you, Edward, we are saving and we are investing, and we need now to start making other avenues of income, other passive income ideas that would help to improve our portfolio and take it to the next level. So when I think of other channels or alternative sources of revenue, what comes to mind, so that you're not just dependent on a job, especially in this market where losing a job isn't new anymore, where when our parents were coming up, they hardly lost their jobs. They could stay in their jobs for 40 years if they wanted to. But here, when you hear somebody has been retrenched, it's not news anymore. And we have to live with that reality that you need several channels of income. What comes to mind when somebody asks you that, I lost my job and I didn't have a plan B, so the saving and investment, kind of got derailed. How do we safeguard ourselves from that? And when it comes to revenues of income, alternative from maybe our main source, what comes to mind?
Thank you for that. Actually, that's what we tell our customers too, right? I'll give you a group of these ladies that were starting to get onto the Uplus platform. I think a 13-year-old, she's getting 200 francs a week from her parents. Yeah. What she did with that is that she started buying rabbits and raising the rabbits and then reselling those rabbits. Right? This is a girl who's not even finished high school. Right? But what she's doing is that she's using that small income she's getting, investing it in a venture, all right, small venture that eventually has the multiplying effect. Okay, so what I tell customers, like, look for something that beyond your actual income, that might not require a lot of energy and time from you, but you know can generate some level of income for you. And once you get inside there, you start getting inside, building it slowly, learning about it, because there's also that learning up, that mistakes you make. And I also tell them, give time for you, create enough room for those mistakes to come, for you to understand them, digest them, and you go back to it. So that's what I say. So once you do that, and if you lose your main source of income, all right, yes, it might be unfortunate, but the other side hustle, they call it, that you're running, might be moving along at a progressive rate. Okay, so that's why I say, like, create time in your day, so you can start investing in something else that's going to provide an income for you. It might not be a lot, but it's a starting point.
Thank you for that, Simon. You had that, so I'm thinking, let's go a little deeper and start to outline types of savings and investment schemes, and give us what you think of those investment schemes and who fits into them, so that we are not just jumping in, especially Kenyans. We're very good at jumping. You remember the Quail saga? And now it's crypto and mobile borrowing. We need to safeguard against that, and we won't do that if we don't know what opportunities are out there and demystifying them. So types of savings and investment schemes, and what kind of people would suit into that. For instance, somebody who is starting now as a 20-something wouldn't be looking at the same investment solutions as a 40-year-old something. Thank you.
So thank you, Irene. Perhaps as I answer that, allow me to comment make one comment on what Njeri had said. Generally, if you eat your future now, your future will have nothing else to eat other than you.
Your future will eat you.
Yes.
You
so
heard that. Yeah.
It requires to think about the future now and planning about it now. Life is intentional, including saving and investment. Things don't just happen, they are caused to happen. So number two, I think we have lost, most people in Africa have lost their savings and their investments because of what Njeri was talking about.
Yeah, I think Anne owes us. You just have to bring, you'll have to bring Simon back at a time when he has better connectivity. It's just kind of, every time you get to a very interesting topic, then it gets disconnected. So you were saying,
you me?
Now we can, but we'll wait and hope that this time it doesn't disconnect. So go ahead.
Yeah, so I was just saying that about, I think it was yesterday, Kenyans are leading in Africa on crypto and other markets, South Africa, Nigeria, also quite close. As a percentage of the population compared to US, we seem to be even far ahead. But a few weeks ago, a substantial number of Kenyans have lost money in crypto. I therefore said, I'm not saying crypto is bad or not. Mine is just to say there's necessity for due diligence. And how does that happen? Check out whichever investment or saving, who is a regulator? Is a product licensed? What is the track record of the provider who is selling that product to you? Now, diving further, what are the opportunities for savings investment? One can save through a pension. Pension is for income replacement at retirement, and that can be by way of annuity for life or embodied in that a healthcare cover for life, because health insurance is a part of risk mitigation at retirement. Now, for most part of the continent of Africa, saving through pension, you save on tax as well, and is quite securely provided within the legislative framework. So you grow your wealth. The easiest way to work out your income replacement at retirement, Irene, if you have, say, 20 million and you want to just quickly work out what's my monthly like for life at age 60, you just take 1% of your lump sum. So if you have 20 million, 1%, that's 200,000 for life. Just by the way, estimate. So pension is one avenue for saving. Number two, of course, I know Irene will talk about the insurance-related products. The other one is you can save through a SACCO. You can save through a chama as well, some of the common opportunities. The key thing is to assess your risk and return expectation guided by the why you are saving and investing. So that will lead you to the provider and the kind of vehicle of saving and investment you choose. Thank you.
Thank you. That is very informative. And Njeri, to build on that, then here we are, we have a lump sum, and we have some investments, and we have some pension. Some people look at insurance as an unnecessary cost, but I'm sure you would have a different viewpoint. Without getting overinsured, how is insurance necessary?
Thank you for that question, Irene. And it's a very good question for Africa, because I think it's the one continent where insurance is really not a priority. We look at insurance penetration, and more importantly, even just perhaps beyond the mandatory classes. But I believe insurance is a very critical pillar of wealth creation. And if you go to the Maslow's hierarchy of needs, you start at the bottom, which is food, shelter, and clothing, which is the basic need. And the next level is financial security. And the easiest way to illustrate this is you buy a bigger television, you buy a bigger padlock. Yeah, so it's whatever wealth you have has to be protected. And allow me to read something just to illustrate how important insurance is to this wealth creation journey. The loss of a key breadwinner in the business or in a household, an expensive hospitalization, loss or damage to property, business interruption, income interruption, all create major financial demands. The business should continue. Spouse and children still required to be educated, clothed, fed, we dare say married for the children, and a financial inheritance still needs to be provided for the grandchildren. And therefore why insurance is such a critical pillar of wealth creation. If you're not taking care of the risks, it means you then cannot plan too long. It means that if you buy that piece of land and tomorrow there's a major hospitalization, you're going to be selling off that piece of land at a quick, probably at a bargain and making nothing. It's going to mean that if you have that longer term investment strategy, you're going to have to break it because you didn't take care of the short term eventualities. So as you create your wealth, you have to take care of your insurance needs. You have to protect. And insurance is risk transfer. Are there risks associated with what you're doing? Are there risks? Perhaps right now, your car, you have it on the road. Is there a likelihood it could get into an accident? I don't want us to work on the likelihood of that. There's always a high chance. So will you stop and repair the vehicle, yours and the other person's, or will you continue with your investments and let insurance take care of that? In case of a hospitalization, and there's a common phrase nowadays, we are all just one hospital bill away from bankruptcy. We are all just a hospital bill away from losing everything we have built. How much insurance do you have to take care of eventualities in case I get unwell? And to put it into perspective, whatever you pay for insurance is always just a fraction. It is a premium. It's just a small amount in comparison to what you're covered for. So what I see is still a lot of education needed on what is the role of insurance in wealth creation. For everybody on this call, my one ask is look at your risks. And the first risk, and I really hope, Irene, we can unpack that, is you. You're not discussing your car, you're not discussing your house, you're not discussing your health. How much insurance do you have on yourself? God forbid, if you're a breadwinner on this call, if you drop dead today, how do they continue? First, how do they send you home peacefully? And then how do they continue to live beyond the now? And taking care of those is the business of insurance, that you transfer those risks to someone to take care of so that you can pursue your investment strategies without a lot of disruption and therefore without having to have unnecessary losses?
That's I think everyone gets it now, that if the most important asset that you have is you, at a very basic level, things like insuring your car that you're using every day and maybe having medical cover so that you don't derail your income so that it doesn't go, everything you've saved doesn't go towards a hospital bill. I think now everyone gets that. So to you, Edward, then I'll ask, if we are looking at assets to invest the money that we are safeguarding so hard, Kenya is notorious for everyone looking for a plot somewhere, a piece of land that, as Simon was saying before, isn't even giving you any decent return. It gives you 1-2% that doesn't even cover inflation, let alone any profit. Looking at our culture and the assets that we go for versus sound investing without putting any emotion into it, what's your view and what do you tell your clients?
I build comparisons, right? So I say, okay, if you put in this piece of land, this is what you'll get after 1 year. If you put it into this government security, this is what you'll get, right? And then I try to explain the risk around it, right? Liquidity issues. If you want to sell this piece of land, how fast can you sell it, right? But if you can go to, the bank product and liquidate your investment, how fast can you get that too? So I try to, compare apples to apples, and I tell them this is exactly why what you grew up knowing and understanding might not be the right way to go with things. Okay, and once you take that emotion, I would say, after 1 year or after 6 months, we can come back and see how things are going. But what I say is that we want to give you options, because the moment you start creating options is when you feel free. Like you have, the bonds around your hands have been taken off because you have options to exercise. If, going back to the whole insurance thing, if something happens out of the blue, you have the insurance that can come in and cover that. Right? If you're looking for investment beyond land, you have those other assets that you put your money in, okay, that give you even a return that's way better than what you have if you put in an idle piece of land that's not being developed. You do not know what the master plan is for that area. Okay, you have to wait for years before you can actually offload it. So I look at trying to find the best way of explaining how you increase the amount of options you have so that you're always in a better position.
Thank you. Thank you for that, Edward. And so to you, Simon, you were just going to tell us about the savings culture in Africa. I know it's very low. You were going to give us perhaps a rough percentage of that. And then we are going to ask, is it too late for somebody who is in their 40s to start investing? Is it too late? Can the situation be redeemed if you haven't started?
So first is that when you look at the insurance penetration, we are below 3% in Kenya. We have other countries that are far ahead, like Morocco, South Africa. They do much better in terms of insurance. When you look at pension, so just about 13% actively. If you especially in the Kenyan context, if you add that to NSSF, then we push it up to about 22% in terms of coverage. But from an income adequacy perspective, we are not saving enough. And so you find income replacement ratios by the time someone gets to retirement, they are below 13%. And let me just unpack what that means. If you have a salary at age 60 of 100,000, what income replacement ratio means that your pension turns out to be 13,000 per month. So that is not likely to support the lifestyle and standard of living before active employment.
Yeah, it's I think all of us agree that Wambo will have to organize another session to bring Simon, because he has a lot for us, but we keep getting interrupted by the internet.
Sorry.
Yeah, we lost you there for a while, and you were saying that 13,000 will not be enough as income replacement.
Yes, and just to quickly tie it up, the levels of dependency at retirement in Africa is also increasingly becoming a concern as a result of modern day parenting. So most youth, they end up having children, they bring them back to their parents to be educated using their income savings. That becomes another constraint. So it therefore merits for, even if someone is at age 4, I just want to, just doing a quick math here, the opportunity of saving, say, for someone at age 30 on a return of 12% per annum to retire at age 60 and saving just 10,000 per month, they end up with 28 million, around 29 million, which gives them about 260,000 per month for life. If this person now starts off at age 40 with the same 10,000 per month, they will be able to, the future value drops from 28.9 to 8.6 million, just because of time compounding. So it helps to begin early, and it's never too late to start. Thank you.
And so, Njeri, as we wrap up, what would you tell somebody who is starting out, the first 5 things that will get them over the hurdle, and make sure that we now change that narrative? Instead of thinking about investing, you actually get to investing. 5 things that will make that solidified in their minds.
Thank you, and I'm glad, because we've been covering quite a number of those. Is the first one, you need to know where your money is going, and that's the budgeting aspect of clearly articulating what you spend. And as I said from the beginning, there is the budget, that is the planned budget, and then there's the actual budget. So the easiest way to get your actual budget is write down every item as you spend it, and at the end of every month, classify it into what is a necessity, what must stay, what is an expendable, what you're doing away with entirely, and what you're adjusting. Now you know where your money is going. And in there, you can clearly indicate how much am I going to put away for what we are describing here. And then the next natural thing is, as you invest, you need to ensure that you are clear on, why am I investing? What is my reason for investing? Because some of that is short-term, long-term, medium-term, and those needs will need to be taken care of. One of the greatest examples I like to use is, if you have children, you have those needs that will come up next, in a couple of weeks, you have needs that will come up 5-10 years from now. And then after that, you need to make sure there's protection. Are you protecting are you taking care of your risks? First risk is you. Are you covered? Because you're going to need that. You're only as tall as your foundation is. So you need to make sure that you take care of insurance. As again, remember, buy a bigger TV, buy a bigger padlock. You're realizing your family is spending more, your family is growing, you're spending more money. Make sure you're upping that insurance to take care of the needs that are required. And at every opportunity, work with a professional, because at the end of the day, we will learn and grow on how much we each know. Stand on the shoulders of those who've done the research, stand on the shoulders of those who've done this, and utilize that opportunity to grow. And last but not least, which is the 5th thing, start now. Start now, because if you wait for tomorrow, I can tell you it's just a good story to have, and it's a very good habit with Kenyans, and I think a lot of Africans as well. When you discuss investments, they tell you, why would I do that? Why not this and why not that? And when you interrogate further, you find there's actually nothing, and which is what is speaking to what Simon is speaking to, that at the end of the day, we wait to depend on our children, we wait to depend on others. And like I tell many parents, breaking news, our children won't take care of us. This generation is different. They're not going to be working hard to take care of you also. They didn't ask for it. So we have to be deliberate to create wealth, not just for now, but for where we are going, so that we can afford our lifestyle. So those are the 5 things I'd speak to, Irene.
Edward, I'll come to you and ask, you're introducing new units in your country, new investment vehicles, the unit trusts, and I don't know if you have equity trusts and things like that. So 3 things that one would require when looking for an investment vehicle that suits them. A, from a risk perspective, and 2, from a suitability perspective.
I say, look at where you are in your life. Are you, graduating from college, looking to get your first job? Are you getting married, about to have your first family, or are you later on in your life? Once you understand that, that's when you know, okay, what kind of products you want to get involved with, because, with a different risk profile that, should help you know how you're going to move through things. So what was the question again?
It's look at 3 things: the investment vehicle, and from a suitability perspective, and from a risk perspective, so that you're not putting money away in vehicles that you don't understand, and then you come back and find your money is all gone.
Right. So the other thing as well is, work with someone who understands this. Make sure it's a daily habit to meet with them, learn, okay, pick up the literature. It might look complicated, or people get scared of it and say, I don't want to touch this. No, what you have to do is to learn about this, so you can start digesting information as time goes on. All right, that's actually even de-risk your side when you're trying to invest and talking to a professional. So that's and as the Rwandan financial market is growing, a lot of companies are coming into Rwanda, trying to set up in Rwanda, providing all the different products. So the amount of options will start to grow. Okay, so if you're working with a professional, at the same time you have time on your hand, it's good for you to start teaching yourself these things, learning as much as you can so you can handle it. And then when you're with friends, and then you can start discussing these things too. But educate yourself, because education is an investment. I believe it does compound too. It grows over time. So what you knew today, if you keep up with it 5 years nonstop, then you'll know so much more 5 years down the road, and you can do more.
Yeah, thank you. That's good advice. Even education does compound. And Simon, to wrap it up, the topic today was creating wealth through saving, investing, and insurance. How do you sum that up all together? What do we take home from the session?
Allow me to say that resources have never been scarce, only resourceful minds are. So it takes...
Say that again, Simon.
Resources have never been scarce, only resourceful minds are.
Okay.
What do I mean by resourceful minds? They is a mindset that has ability to see and not to look, ability to see opportunities in the ecosystem of environmental resources that we are in, and turning it around. 1, to attract it your way. 2, to preserve. 3, to grow. But that requires a strategic intent. So I go back to what I began by saying, what is your money vision? And how will you get it? Thank you.
Thank you so much. Resources have never been scarce. It's only resourceful minds that are scarce. So you're giving us a challenge. We have to go and reassess ourselves and see, are we the resourceful mind? Edward and Njeri and Simon, it's been a really good session. Thank you for making the time. And it's interesting that 1 hour annual agree is just not enough. So we are hoping that you'll bring the same setup next, and we can continue with this conversation, because the deeper we get into it, the deeper it gets interesting. I thank you so much for making the time and being prepared, because we definitely, every one of us can pick a few points that will definitely stick, that we'll take with us. And so to the panelists, I thank you very much. My name is Irene Gathiaka of Nairobi Business Forum, and back to you, Anne.